Good morning, everybody. Again, as Joe said, Linda Levy here. There's a lot of information to know when it comes to financial planning. So today's topic, I figured I would talk about the differences between exchange traded funds and mutual funds. As a financial advisor, we always have disclaimers we have to show. So I'm going to show that now. Okay, good. All right, so now think about your first time to swim. Do you remember your first time at a swimming pool with the big diving board at the end? I think of the process of learning how to handle your money as similar to learning how to swim. At first, you start at the 3-foot end, slowly walking down the stairs aware of the water coming higher. It feels cold and strange. You're nervous about the water going over your head. The more times you return to the pool and develop your ability to swim, the fear subsides. Starting out with investing in the market can be the same. You can get used to the feel, you build your confidence, and you become more secure. Then as you feel more secure, you wade down toward the middle of the pool where your head could be underwater. The fear might have returned now. The same feeling you had when you first entered the pool. Will I drown? Can I swim well enough to stay out of trouble? Again, the market can be similar. You may ask yourself, am I invested correctly? What will happen if and when the market tanks? Will I lose everything? Will I drown? You acquire a nice pair of goggles. Pretty soon you can see underwater. The mysteries of what you couldn't see now becomes more visible. Time passes and the fear once again subsides as you get comfortable with the new depth you have now taken on. So today, with all the different aspects of the market, I'm going to talk about the mutual funds versus exchange traded funds because I have a lot of people ask questions about that. So the advantages and disadvantages. 1, exchange traded funds are less expensive than a mutual fund. Advantage of the lower fees is there's less drag on potential return. Disadvantage is exchange traded fund doesn't adjust for market fluctuation while the mutual fund may be able to. 2, actively managed mutual funds tend to come with higher expensive ratios. As an investor, verify that the returns differ from the stated benchmark so they are getting the benefit of active management. This can be done by asking prior to the time of purchase. A good active manager can add value over the long term, but if the mutual fund is simply tracking a benchmark, a less expensive exchange traded fund can typically be found. 3, exchange traded funds can be bought through an advisor or by an individual. For a do-it-yourselfer, an investor can open an account through E-Trade, for example, and pick their own funds and avoid a fee. For someone who wants direction, an investor could purchase shares through an advisor who could help them pick a fund to match their risk tolerance, time frame, and liquidity needs. 4, exchange traded funds have to be purchased or sold as a whole share. This means advisor can't buy just a portion of a share. In other words, if you had a stock you wanted or a fund you wanted to buy that was more expensive, you couldn't just buy a portion. You'd have to have the full money set aside for the whole purchase at one time. And that the disadvantage of that is then you might be priced out of something you really wanted to get into. 5, mutual funds can be purchased in partial shares, which means an investor can start with a smaller amount. You can actually start investing with specific dollar amounts rather than have to buy whole shares. The advantage of that is now you have more options of the different kinds of shares that you can buy since you can buy partial shares. 6, mutual funds can be set up on a monthly automatic basis to buy based on a set dollar amount as low as $50 a month. The advantage is monthly purchases can be easier to transact. The disadvantage is they do have a higher sales charge. 7, monthly purchases of exchange traded funds would require the investor to pick an exchange traded fund with a particular budget, so lower monthly purchases would be tougher to accommodate. The disadvantage is that monthly purchases are not as simple to accomplish. 8, with exchange traded funds, prices are calculated throughout the day since the trading occurs constantly during market hours. This requires a lot more monitoring if an investor is trying to time the market. The advantage is the price is instantly known. 9, mutual funds are calculated at the end of the day, only when the trades are executed. When buying or selling, the transactions can be indicated through a specific dollar amount, unlike exchange traded funds. The disadvantage is an investor has to wait to the end of the day to know how many shares they actually were able to purchase or how many were sold when the dollar amounts are used. 10, side note, when purchasing an index fund, An investor does not get an even amount of each of the shares indicated in the index fund. For example, if you bought $500 worth of the S&P 500, for example, you would not get $1 of each of the shares as represented in that index. The shares are not represented on an even basis. Index funds cannot outperform the market. Again, they cannot outperform the market. 11. Exchange traded funds have a big advantage for non-qualified accounts, which are accounts that are not IRAs or Roths or other retirement accounts. Since the funds are traded in a full of funds not sold, there are no capital gains incurred. This isn't such an important factor for IRA or Roth accounts, since capital gains are not realized until the funds are sold in each of these types of accounts. Advantage is that there will be less tax implications for exchange traded funds in the accounts that are set up for more liquidity, such as non-qualified accounts. Mutual funds are sold in comparison, so capital gains can result. As always, see a tax advisor. 12. Both exchange traded and mutual funds can be invested in sectors and size. Most exchange traded funds have 40 to 100 separate stocks. Mutual funds on average have about 75 to 150 different stocks, so both offer some diversification. 13. Both exchange traded funds and mutual funds can be held in a managed account. I compare management to non-management to a car with 3 lanes to drive in versus 1. With management, the holdings can be adjusted according to what the market is doing. If a drop in the market is anticipated, the fund manager could attempt to reduce their risk by changing some of the holdings in the funds. Like a car slowing down or moving to the left lane, there could be more cash and other less aggressive stocks. On the other hand, if an investor wanted to be more aggressive, say step on the gas and move to the left lane, this could be accomplished by reducing the cash and hold more aggressive stocks, such as small and mid-cap investments. With professional management, the investor has a team to do the research to stay abreast of the changes continually throughout the world that can make an impact to a particular fund. They typically offer better returns than a non-managed account due to the reallocations and rebalancing that takes place. In addition, having an advisor can help an investor to make personal choices that fit the purpose, the objective, and the time frame of the money being invested, as well as encouragement to take the steps to move forward. Now, remember the pool I brought up earlier? We're now going to look at the deep end of the pool where the high dive is. When I was a child, I remember a high dive that was so high I had to tip my head back to look at it. All I could see was the underside of the board. I remember wondering how many steps were there to climb just to reach the board. I watched several kids climb up step after step, getting higher and higher, walk out, stand on the end of the board over the water, looking on to all of us down below, and then freeze with fear. They looked so small from such a height. Others below would cheer them on. Some would jump, some would retreat. The ones that would jump would have the experience of their lives, plunging deep into the water. With some additional strokes and kicks, they may even be able to touch the bottom. Sometimes there were cool things laying on the bottom for those who could reach them. Just like the diver, as a person builds for wealth, new opportunities become available to them that isn't necessarily there when they first start. At the same time, just like a person who doesn't know how to swim, someone with little experience may want to rethink the deep end of the pool. So if you want an advisor that can talk you through the steps and when to take them, as well as someone encouraging you on when you're unsure of the next steps to take, like the kid on the high dive, please consider giving me a call or emailing me. I've been advising for over 20 years and would be glad to do a complimentary consultation. Thanks for your time.
All right, great, Linda. Thanks so much. Does anyone have any questions for Linda? Linda, I have one, just kind of a basic question. When we're talking about mutual funds, for the average investor, isn't that the way that most of them are going to go, just simply because it spreads the risk out amongst different items? If you can speak to that a little bit, that'd be cool.
Yes, exactly. That's why I think mutual funds are usually the entry point for most investors. The reason why is on a mutual fund, when you put money into it, as I mentioned, most mutual funds will have 75 to 150 different stocks within it. So let's say you put $100 in the mutual fund to get started. You now have that diversification over all those funds. and then they're bought, and the money manager is actually going in and making changes in those fund holdings for you on your behalf. So it's the cheapest way, as far as for small, starting out small accounts, for somebody to be able to get that management. When you get into a bigger account, then you can start having active money manager handling different stocks. But a mutual fund is a great entry point. So
Cool. Other questions? Dana.
So Lynn, there's a lot of information nowadays on television commercials, and they talk about doing all this day trading and stuff like that. What are they trading?
that is, I think a lot of people, there's a lot of, like you said, there's a lot of information. So a lot of people do want to get out there, and they've heard about certain stocks being something they want to get into. So they want to play with that. I tell people, if you want to do that, that's great. But I would not suggest doing more than 10% of what you have in assets, liquid assets, into something like that, because you can lose your shirt. I had an uncle who actually had to sell his house because he did that very thing. And he mortgaged his house, and then the stock went belly up, and he had to sell his house. So there's some nightmare stories. So just be careful when you're doing that kind of trade. Don't let fear or greed control your decision, basically.
Good advice. Who else? I saw another hand. Who was that? Was that Matt? Matt, please go ahead.
Hey, Linda, I remember I heard once that, like, depending on what company your financial advisor works for, a lot of times they're partnered with some of these mutual funds or these ETFs, and they might be a little more inclined to push certain funds, even if it isn't necessarily in your financial plan. Is there any truth to that? And if there is, I mean, I would imagine you're probably able to avoid that since you're independent.
Exactly. Yeah. As working for, I worked with Waddell and Reed, and I also worked American Express Financial Advisors. I definitely did see with the big boxes, they do have their products they're going to push, and you can kind of understand that that's true. They also have a limitation sometimes of what you can offer. When you're independent, you don't have anybody trying to push a particular product, and you also are not as limited as to what you can offer. So that's one of the reasons why I did go independent.
Awesome. Very good. Any other questions? All right, Linda, why don't you tell us how people can get a hold of you?
All right, so I'm Linda Lovey, Lovey Wealth Management. My telephone number is 775-544-4714. My email is LLOVIE@brokers, so that's BROKERS, I for international, F for financial, S for services.com. You can also go onto my website at www.LLOVIE and hear about more stories that I ran across, things I've shared, and also use the contact form to get a hold of me there.